analyst recommendations. Now, why do we need to talk about analyst recommendations? There are two reasons. One is it is a very important field of finance by itself in terms of the industry, right? When I interview students for our master's program, like maybe out of 10 students, you will have 6 of them saying they want to become an analyst. So this is a very big part of the finance industry, producing recommendations and reports about companies. So that's one reason alone for us to study them. And the second is it gives us a motivation to think about how people make predictions and whether they are not accurate in some systematic ways. Right. So first of all, let's talk about the empirical part of studying financial analysts. So analysts are responsible for giving trading recommendations. So usually, their recommendations would fall into one of the following 5 categories: strong buy, hold, sell, and strong sell. They might not use this terminology, but pretty much they would be implying something like that, right? I highly recommend this company. I think you should be cautious. Pretty much you can translate what they say into one of these 5 categories. And as we saw before, the IBIS dataset already transcribed all the analyst recommendations into the scale. Besides just a simple recommendation of what to do, specific price targets are sometimes provided. And it should not be surprising that popular analyst recommendations can have considerable market moving power. If you read financial newspapers, then when a major investment bank come out with a new report, it does have considerable attention given to it. There are 3 categories of analysts. First, there are sell-side analysts, which work for service brokers, particularly investment banks. So these are the analysts that work for Goldman Sachs, works for Morgan Stanley. They're probably the most frequently quoted category. There are buy-side analysts. That's what the people in individual funds do. If you work for a hedge fund, you do analysis for the hedge fund for their own investment strategy. You're not necessarily publishing a report for anyone else outside of the company to read. So the analysis is probably not going to be public. Third, there are independent analysts with no particular affiliation. They usually sell recommendations directly or indirectly. You see a lot of advertisement on Yahoo Finance, right? They have these reports and ask if you want to read more, click on this link. We think the following 10 stocks are going to do well in the next year. Click to read more. Most of the study is going to be on sell-side analysts because they're most systematic and public. So you actually can get hold of them. Now, the first question we should ask before we actually check for accuracy is, should we expect accuracy? Is there a reason to expect accuracy? One reason to think the answer is yes is analysts do have better access to information about the firms they cover. Important analysts talk to management. They have access to some company records. So they would have a better idea than the average in knowing how the company is doing. So that's a reason to expect accuracy. On the other hand, you also have to consider incentive. Right. So now first, investment banks are called investment banks because they help companies with various financing needs, right? IPOs, SPOs, borrowing, hedging, and so on. while legally there should be firewall between analysts that issue reports and investment bankers within the same company, in practice there has been more than one instance where you see that there is a conflict of interest. So that's one reason we might think that accuracy might not be the biggest concern. Second, hired gun, paid research. If you are familiar with financial news, or if you like, for example, if you watch the recent movie, the Big Short,孤注一擲, then one thing they mention is that rating agencies are paid by the companies they rate. That does create some perverse incentive, right? So, paid research. There is also the commission from generating trade. In most major investment banks have big trading desks, which takes commission when people trade. So this might be an incentive to issue revision of recommendations to generate trade. So that's another possibility. I was reading Warren Buffett's one of his letters to his investors, and in one of the letters he mentioned like what he observed from investment bankers is investment bankers like to give advice to company leadership. First, they would say, well, you should buy this, you should acquire this other company, because when you acquire the company, you would have control value. You control that company, you can maybe exert synergy out of them, right? So you hire an investment bank, you go through all this process acquiring another company. Then, after you acquire the company, some investment bankers, maybe not the same one, would come to you and say, you should consider splitting off your subsidiaries. That would allow you to capture market value. So now you're actually giving up what the control value in chasing for market value, right? So in this process, who benefits? The investment banks that provide service for commission. So this is another reason we might be cautious about whether analyst recommendations are. So we're going to consider a simple model where analyst knows the true value of stocks. So this is a big assumption already. But let's just take that for granted, that they actually know what they're saying. And there are two types of analysts. The first type cares about the truth. So the first type wants stock price to be the true value. We say this type of analysts have aligned incentives. So they have the aligned incentive with investors. They want the stock price to reflect true value. The second type want inflated stock price, right? These would be the sell-side analysts. So we say they have misaligned incentives because what they want is different from what the investors want. The investors would want the stock price to reflect the true value. So, will we see truth telling? Will we see truth telling? Now, it's quite clear that the second type doesn't have an incentive to tell the truth, right? If I am in the business of trying to inflate stock price, what I should do is to just paint a very rosy picture, saying that the stock is worth a lot more than it truly is. That's the way you inflate stock price. But what about the first type? For that, we should think more carefully. Okay. Now, if the fraction of analysts with aligned incentive is 1, that is, every analyst has the same objective as investors, So they all want the stock price to reflect the true value. Then the analyst will tell the truth, because if everyone has the same idea, the stock price should reflect the true value. Let's tell the truth. And what if the fraction of analysts with misaligned incentive is 1? So that is every investor, every analyst wants to inflate stock price. Now this is a more interesting case, because what do you do in this case? Clearly, the analysts have an incentive to report higher forecast, because they want to inflate stock price. But then it's also not clear that they're going to have an effect, right? Because if you believe investors are smart, in particular, if they have rational expectation, then eventually they would adjust for all the rosy recommendations, right? You know that they're going to inflate, and you know everyone is doing it. So in that case, you just mentally add in a compensation. So if they say stock price is going to go up by 50%, you take a discount. Maybe it's going to go up by 25%. Maybe it's going to go up by 10%. So, but then the analyst will lie. What if there's a mixture and the investors cannot tell the two types apart? This is the case that's more tricky. Let's think about what you're going to do. Let's say you are a analyst with aligned incentive, so you want the stock price to reflect the true value. And I am the bad type. I actually want to inflate stock price. So clearly, I'm going to report a very high expected stock price. That's what I'm going to do. I'm going to report a much higher stock price. Let's say the current price is 10. I'm going to report 15. Now, given that your incentive is to make sure that the stock price reflects the true value of 10, and you know investors trust you and me equally because they can't tell the two apart. Okay? So you want the stock price to reflect the true value of 10. I am forecasting a price of 15. What price should you forecast in order to bring the investor expectation to the true value? 5, right? In fact, that's the problem, right? You would want to underreport precisely because you want the investor's expectation to be correct. I overreport, so you compensate by underreport. So we actually do not see truth telling in this situation. Right. So more formally, you can express intuition in a very simple model, right? Suppose there are fraction P incentive aligned analysts and 1 minus P misaligned ones, and assume the misaligned analysts inflate their reports by B, it's a certain amount, right? As an investor, what do you expect? What do you expect? Now, here's the part I have to be very careful because I'm not sure the pen is going to work as in previous cases. Right? Okay, so what would you expect? What would you expect? Now, if you can't tell the analysts apart, then obviously what you're going to do is you're going to take the average you're going to take the average of the reported prices and subtract an amount out of it, right? So you can take, so this is the area where I shouldn't have used P as the probability, but let's just use R as the return. And then you're going to subtract 1 minus P times B, right? That's what as an investor, what you want to do. You want to compensate for the fact that you know some of them are going to be giving inflationary reports. So you subtract a certain amount, adjust by the proportions. As a analyst, which you actually cares about the price being accurate, you know that if you report truthfully, this number is actually going to be below the true value, right? If the investors are adjusting in the following way, then you actually have a problem. So it's impossible for the analyst to always report truthfully, even if their incentive is aligned with the investors. So what's one possible equilibrium? So one possible equilibrium is investors discount very rosy recommendations. So let's just take a look in what happens in the model first. So we're going to propose the following equilibrium. This is a Nash equilibrium, as in game theory. One possible equilibrium is investors discount very rosy recommendations, pay attention to discouraging recommendations. So we're going to assume B is very large. So the buy side, the sell side analysts are actually going to give you very, very biased reports. So the investors were going to believe in the following way. They only believe the report if the report value is below a certain number, theta star, and believe the true value is theta star otherwise. So that is, there is a cap in which I will believe in you. If you report that your prediction is going to be below, if your prediction is below that cap, I believe in you. So it could be negative, right? It could be saying the stock price is going to go down, or it could be saying that the stock price is going to go up slightly, but not a lot. As long as it's below the cap, I believe in you. But if you report a prediction that is above my cap, then I don't trust you. I think you are just making it up. So that's what that's the investor strategy. And the analyst strategies are going to be, for the aligned analysts, they're going to report the true value if it's below theta star, and report theta star if it's actually above. And for misaligned analysts, they're actually going to always report theta star. So we're just going to think about this and see whether it's actually a Nash equilibrium. Now, if you have taken microeconomics, then you know Nash equilibrium is defined as a stable situation, right? Given what you do, I don't want to change what I do. Given what I do, you don't want to change what you do. So it's about, Nash equilibrium is all about stability. So is this stable? Think about it. It's actually easier to start from the analyst, right? Given the investor's belief, can the sell-side analysts do any better than that? Remember, the sell-side analysts want to inflate prices, so they want to report the highest possible prediction in which the investors would believe in. Given that investors have a cap, they would believe nothing higher than theta star. The best you can do in inflating stock price is to report theta star, right? Anything above, no one believes anyway, so why? There's no point. So for the misaligned analysts, the ones working for the sell side, this is the best you can do. The most you can contribute to distort what the investor believe is to report the highest value they believe in. So that's actually stable for the misaligned analysts. They have done their part. Report the highest value that the investors would believe in. What about the aligned analysts? Once again, even if they believe the company's outlook is very good, given that investors do not believe in rosy reports, there's no point in reporting them anyway. So then they report the highest value that the investors would believe in. But for more pessimistic assessment, they do know that the investors believe in them. The investors do believe in pessimistic prediction, pessimistic forecast. So in that case, there is an incentive for them to report pessimistic forecasts because the investors do believe in them. Once again, this makes for a stable strategy. What about the investors? So given that the analysts report in the stated way, is it optimal for investors to have such a strategy? Believe in pessimistic reports, but set a cap for optimistic reports. Okay, so let's start with the pessimistic ones, right? So should the investors believe in pessimistic reports, the ones that are below theta star? The only analysts that are going to provide pessimistic reports are the aligned ones, so which tells the truth. So this part of the strategy is optimal. The only one that's going to tell me bad news are the ones that are actually truthful. So I should believe in them. So this part is stable. What about the part about believing the true value is theta star otherwise? So this concerns with what you want to do when there is a rosy report. In this case, the true values. So the aligned ones are understating, whereas the misaligned ones are overstating, possibly overstating, right? So this is optimal, but the precise cap you should set depends on the ratio of true-telling analysts to the non-true-telling ones, right? If in the market most of the analysts are truth-telling, you can set a very high cap and you're still getting good information. But if in a market where you have you have a lot of misaligned analysts, you want to set a low cap. So this is stable as long as you set the right cap, and the cap adjusts, theta star adjusts to the ratio of good analysts to bad analysts. So this is really basically a kind of a variation of the market for lemons. So this is the game theoretical analysis, that facing a situation where you cannot distinguish between good analysts and bad analysts, what investors can do is, instead of just believing in what the analysts say and simply packing on a certain discount, you can actually exploit the fact that the misaligned analysts are not going to give you bad reports. So you believe in the pessimistic reports and be cautious about the optimistic reports. What this predicts about market reaction to analyst report is, when pessimistic reports comes out, you should see a big market reaction because everyone believes in pessimistic reports. But when there's an optimistic report coming out, then you should see a much smaller market reaction. And that's what we're going to see next, whether empirically that holds true. Okay, so the first paper we're going to look at is Stickel, 1995, published in Financial Analyst Journal, the anatomy of performance of buy and sell recommendations. He looked at 8,790 buys and 8,167 sell recommendations made by 1,510 analysts between 1988 and 1991, covering 1,179 stocks. It's not a particularly big sample from today's perspective, but it's one of the first papers, so let's take a look. This is the diagram that shows the effect. The vertical axis is the mean cumulative abnormal return, So adjusting for the market movement. And the sell, and then the horizontal axis is the days from the report coming out. Okay, so the solid line is the cumulative return, abnormal return from buy recommendations. Dotted line is the cumulative abnormal return from sell recommendations. And so what do you observe? And to help you with that, let me actually give you a dotted line. The red dotted line is the day in which the report came out. Okay, so what do we see? First, you do see the market react in the correct direction, right? In this particular case, the market is reacting in the correct direction when there is a positive recommendation, a buy recommendation, the market goes up. When there is a negative recommendation, the market, when there's a positive recommendation, the stock price goes up over the market itself. And where there is a negative recommendation, the stock goes down over what the market trend was. Right, so that's the right direction. That's the right direction. It's not in the adjustment wasn't immediate, right? You see there's some curve. It's certainly not immediate. So you see that it's kind of moving up slowly and moving down slowly. So it seems to take like a week or two for the information to be digested, suggesting that information is not spreading immediately. Okay, maybe that's the case. Furthermore, there's one thing very interesting. Notice how the prices have started rising or dropping before the information came out. So there is some sort of information leakage. All right, so I forgot to actually press the slides. So downgrade to strong sell and sell have greater negative price impact than downgrade to hold. So that's something you can't really see from this diagram. So bad news actually have a stronger reaction than just simply going from positive to neutral. So people do take notice of pessimistic recommendations. There's no similar effect of upgrades. That is, moving from hold to buy does not have a stronger price effect than moving from sell to hold, right? So it's like when I tell you things are really bad, you notice much more than I say things are not as good as before. But when I tell you things are really good, you don't really pay attention. To you, me telling you things are really good is about the same as me telling you things are not as bad as before. A stronger signal results in a stronger effect on price. So if I go from hold to strong buy, you notice more than if I go from hold to buy. And obviously, if I go from hold to strong sell, you're going to notice a lot more than anything else. Okay, so now we're going to separate the results into companies or by companies of different sizes. So the solid line, I believe, the solid line is the smallest firm, followed by the so the solid line on the top is the smallest firms by recommendations. Okay, then followed by this big dot thick dot is large firm buy recommendations. Then the smaller dots is small firm sell recommendations. And lastly, this dashed line is large firm sell recommendations. Okay, maybe I'll write it here. Small buy, large sell, large buy, and small sell. What do you notice? I think what you should notice is, while the effect for small firms are large and in the right direction, the effect for large firms are small and in the wrong direction, right? When I recommend you to buy large firms, and if you listen to me, it actually goes the wrong way. So if you think about it, it does make sense. For small companies, it might be very hard to get any information about them except from analysts. And furthermore, there will be fewer analysts covering small firms. So when there's information coming out about a small firm from an analyst, that might be information that very few people have ever heard of. That would result in very large market reaction, and which is exactly what you see. For large companies, you have a lot of sources of information. Maybe there are a lot of analysts covering them. There might already be news about those companies without any analyst recommendations. So it's not surprising that there's not a lot of effect on large companies. Okay, so this is the first study. Now we're going to move on to the next study, which was published only 1 year later. This happens a lot in academic research. Like multiple people just come up with the same idea. This is not the most fascinating case, right? You have two people coming with calculus at the same time. Like, how is that possible? So Womack, 1996, published in Journal of Finance, do brokerage analyst recommendations have investment value? So it only analyzed the most extreme change in recommendations. So going from hold or below to buy, going from buy to something hold or below, going from hold or above to sell, and going from sell to hold or above, right? So small changes like sell to strong sell and buy to strong buy are ignored in this study. 1,573 recommendations on 822 companies. And once again, this study, as in the previous one, takes an event study approach. So 0 is the date in which the date when the recommendation came out. Oh, wait a minute. I want the red one. Okay, so wasn't very. Okay, that's better. All right. What do you see? Once again, noticeable market reaction at the day of reports coming out, right? Add to buy, there's a jump on that day. Now the dots, it's more like triangles. The triangles are so the triangles, if you take a look at the left, the vertical axis legend is that's cumulative average return. Cumulative average return. So the triangles or the line, if you if you want to say. The line at the top, it's cumulative returns. So you see a jump in cumulative returns, followed by a slow increase, telling you that once again most of the effect comes from the first day of announcement, but then there's still a slow spread of information subsequently following. Okay, that's for buy. For sell, the effect is much larger, a significant downward drop in return, and then you see that bad news spread a lot quicker than good news, right? Because the jump is almost complete in the first day. There's relatively little movement afterwards. So bad news spread faster than good news. Or you can say people take notice of bad news a lot more. The bars at the bottom are at normal volume. So basically the volume over some sort of average. It's a 6-month average. It's a 6 months average. So as you see, most of the trading in response to a analyst recommendation comes from the first day and maybe the second day. You also notice there's, once again, possibly some information leaking out, or perhaps, well, it's not necessarily some sort of insider thing, right? It could be just some other people have noticed something similar. Because you can see that volume also went up before the report came out, right here and here. It's a small effect, but there it is. And once again, it's by now quite standard to separate the effects for large companies versus small companies. There's stronger effect for downgrades than upgrades, much stronger as you see, like 3 times larger. So people do react to downgrades. Small companies respond much stronger. If you look at these lines, for the left-hand side is buy, right-hand side is sell recommendations. The stars are small companies, circles are medium companies, the diamonds are large companies. Not a lot of difference between medium and large. Very strong reaction to small companies. For small companies. Similarly, for sell recommendations, large effect for small companies, somewhat similar effects for medium and large companies. All right, so what do we get out of these 2 studies? First, the market do react to them, but much stronger to sell reports. Second, the strongest effect comes from small firms, right? So that's something you have to consider when you think about whether the reports are important in investment decisions. Now, next thing we want to consider is how quick do we have to react to the analyst reports? So, is it a viable trading strategy to trade after you hear about a analyst recommendation? You can think of a trading strategy in which you just use the IBIS data, right? As it comes in, if you see there's a positive recommendation, you would buy more of the stock. And if this has gone down to a negative recommendation, you sell them. Would that be a viable trading strategy following analyst recommendations? Okay, so this is the next study. Barber, Ali, 2001. Can investor profit from the profits? Security analyst recommendations and stock return, published in Journal of Finance. This is a this can use a lot more data. 361,000 recommendations from 1985 to 1996. It's actually the same source as Stickel 1995, but just use a much bigger version. But instead of using an event study approach, which you just trace what happens before and after an announcement, this study used a portfolio formation approach. So we're going to form a trading strategy. We buy the stock that are recommended, sell the stock that they're not recommended, see what's happening. So, okay, that's exactly what I do. Buying the most recommended ones, selling the least recommended ones. All right, so what do we see in this case? First, the good news. Recommendations correlates with return. On the left-hand side, you have the most recommended stocks, and towards the right-hand side, you have the least recommended stocks. As you can see, the most recommended stocks do have much higher return than the least recommended ones. Now, on the very right side, the white bar represents the average market return, and you can see that, roughly speaking, on the middle category, number 3, it's very similar to the market return. Second, the speed of portfolio rebalancing is crucial. Realistically, most investors simply cannot react to recommendations immediately. Investors might not be checking daily, so they might get news later. So we would like to know what happens if they delay reacting to the news. So in this table, you read from the top to the bottom. Panel A, 1 week delay. Panel B, semi-monthly delay. And panel C, 1 month delay. So this, as the title suggests, represents the hypothetical delay from the time of the recommendation coming available. P1, most favorable, is the long portfolio of the most favorable stocks. P5, least favorable, is the long portfolio of the least recommended stocks. So P1 minus P5 is a long-short portfolio, longing the most favorable stocks and shorting the least favorable stocks. The return of this long-short portfolio is positive, on average 0.723% a month if there's just a 1 week delay. This return is mean raw return, so it hasn't been adjusted for anything. And it's statistically significant as indicated by the T statistic below the point estimates, 2.838. The authors bold the number when it's statistically significant. Moving down to semi-monthly delay, you can see that the long-short portfolio generates a 0.6% return monthly on average, and is still statistically significant. But with a 1 month delay, the return has dropped to 0.429% on average a month, and it's not statistically insignificant. From the left to the right of this table, the authors try different types of controls. First, adjusting for the mean market return. Second, adjusting for CAPM. Third, adjusting for Farmer French. And finally, adjusting for Farmer French plus momentum. So that's called 4 characteristics. So for the last 3 columns, the numbers reported are the intercepts from those adjustments. So if you remember from previous class, that's actually alpha. As you can see, the results pretty much stays the same for most of the cases. That is to say, a smaller delay, a shorter delay, would give you a much higher return than a long delay. Just not spend the time here. The strategy works better on small firms as expected. S and B. S is small, M is medium, B is big. So if you look at it, the raw, no matter whether you're looking at the raw returns or you're looking at the adjusted returns, they are all better for the small firms. So if you look at, for example, actually if you look at the let's look at the most extreme one. If you look at the returns, the abnormal return, after adjusting for CAPM, pharma French factors, and momentum, you see that small firms still give you a very decent profit, but not for the big firms. The big firms, in fact, does not have any statistically significant profit by following recommendations. And the point estimates are also much bigger for small firms. It's like five times. So once again, recommendations are mostly useful for small firms. Okay, so here's the bad news. Take a look at the turnover. In order to execute strategies, the turnovers are all in the range of hundreds of percent of your portfolio, right? In order to execute a long portfolio, you have turnovers like 265% for small firms and 618 for big firms. Why is it bigger? Why is the turnover bigger for big firms? Because there are more analysts covering big firms. So in order to follow the recommendations, you have to trade more often. If you implement a long-short strategy, just for small firms, the turnover will be 622% of your portfolio. And for large firms, it's going to be 1,256% of your portfolio. So this is very, very high turnover. And turnover is a big determinant of your return because every time you trade, you pay commission. So, after subtracting the assumed 0.7 to 4% transaction cost, pretty much you're always left with negative return. So, unfortunately, as a typical investor, it's almost impossible to use this strategy. The turnover is simply too high. It remains to be seen whether a simplified strategy would help. Now, a simplified strategy probably takes the form of essentially delaying reaction, right? Instead of relying on individual reports, maybe use some aggregate reports. But that's the same as saying you delay. And we see that delaying also lowers your profit. It's not very clear from here whether the trade-off is worthwhile. So you delay, lowering your profit, lowering your return, but then you trade less often, which would raise your return after commission. So maybe, but overall, the evidence is against using this strategy. It's simply too costly to trade. All right. Okay, what's the next one? All right, so we can actually cover the next one. We will cover the next one, and then we'll leave herding for the next time. All right. Jegadeesh et al. 2004, analyzing the analysts. When do recommendations add value? All right, same data source and Stickel 1995 and Barber et al. 2001. I think actually they might all be just using IBIS. I think they're all using IBIS. So it's the same data as we have access to through WRDS. 1985 to 1998, averaging 971 observations per year. And the focus is, does recommendations provide additional value beyond the underlying characteristics of stock they recommend? Now, this is actually a question that we haven't considered up till now, right? So analysts recommend stocks. There are two possibilities. One, they have some inside information that we do not know. So when they recommend, it's actually valuable to take notice because that's not what we already know. Another theory is they're simply recommending stocks that tends to do well on average. For example, they recommend value stocks. We already know value stocks tends to do well, so they're not really adding any value. Or another example, they're simply recommending stocks that are doing well in the recent past. That would be momentum. We already know momentum exists, so we don't need analysts to tell us that momentum exists. Okay. All right. So what does this paper look at? So ignore Q score for a moment. Let's just Q score is just a composite score that the authors come up with. Let's just focus on what we know, such as momentum in the middle. So looking at stocks that have been doing well recently, what do we see? What do we see? How do we interpret this diagram? So the you see that this is a very complicated diagram. In each diagram, there are multiple groups of bars. Each group represents one particular holding period. For example, this is like 1 month, holding for 1 month, holding for 3 months, holding for 6 months, and so on, right? So each group of bar is one particular holding period, okay? All right? And then we ask the questions. Let's see. Right. I think. Let's see. Let me think about it. Yes, these are long-short portfolios. Buying the most recommended ones, selling the least recommended ones. Just like the previous paper. These are long-short portfolios. Then what are the bars? The bars are how good the stock is based on this particular criterion. For example, in this case, in the middle diagrams, momentum. The stock on the left have negative momentum, so that is they're going down, right? And the stocks on the right have positive momentum, they're going up. Okay. So since these are long short strategy, it tells us the value of following the recommendations. And what you see is the bars are negative for stocks that have negative momentum, it's going down, and positive for the stocks that are going up. What this says is, if the stock is going up, then it actually gives you profit in following the analyst recommendations. The white bar is sticking up. But if the stock is having poor characteristics, like going down recently, then following recommendations is actually going to give you even worse performance. Remember, these are long-short portfolios, right? So these negative returns comes from following the analyst recommendations. What's happening here is, if the stock is going down, then buying the recommended ones, so you're buying recommended stocks that have been going down, and selling the least recommended stocks that have been going down, right? So it's kind of a two-stage strategy. You are buying stocks that are recommended but going down, and you're short selling stocks that are not recommended but going down. That actually gives you very negative return. Bad idea. So what this tells you is, analyst recommendations seems to make sense only when the underlying stocks are actually performing well. Okay. That's what it says. So that's for the top diagrams. Top diagrams, there are 3 measures of how good the stocks are. Almost in all cases, when you follow recommendations for the worst stocks, you're actually going to lose out. But if you follow recommendations for the good stocks, you're okay. So that's for the absolute recommendations. Buy recommendations, sell recommendations, so on. What about the bottom 3? The bottom 3 is, instead of looking at what the recommendations are, you actually look at recommendation changes, right? So in the bottom 3 diagrams, what you're looking at is you're essentially you're looking at upgrades and downgrades instead of buy and sell recommendations. And what it turns out is, no matter the stock's underlying characteristics, following upgrades, so buying upgrades and selling downgrades, is always a good idea. All right? So the second lesson we learn here is that when you look at analyst recommendations, you should be looking at upgrades and downgrades, not what the analyst recommends. It's much more meaningful looking at the changes. Okay? So, to conclude, in this paper, level of consensus recommendations only add value when the underlying characteristics are favorable. When the underlying characteristics are unfavorable, high consensus level is actually bad. Finally, change in consensus is a much stronger return predictor, largely independent of underlying characteristics. So this is what you should look at, right? But this would also require your ability to do data analysis, because the level can easily be found. If you search through news articles, you would find the level. To find the change would require you to either have access to precompiled data, or you have to do the data analysis yourself. Right? So in that sense, it's not surprising that the change is more meaningful. It's not as easily accessible as the level. All right, so we're going to stop here today. Next week, we'll continue with whether the analyst follows each other's recommendations. All right, stop.